What if I told you it's a way to supersede what you're going to do in 5 years and do it today? Well, I had an epiphany moment, well, more like my client had an epiphany moment with me about why she should not wait to buy another house. It was great too, because we went over the cost of inaction. So we're going to break down how much money she is going to save by not waiting 5 years until she retires to buy another house, but actually doing it now, and how much income she's going to make, how much deductions she's going to have, and then also the cost of her not waiting. So before we get started, as always, like, subscribe, share to our channel. In real life, I'm a certified financial planner helping thousands of clients worldwide, but on these social media airways, we're just giving information. This information is good for you to scale your business and transform your finances, as we saved our clients over $25,000 in tax savings while giving her an extra $18,000 a year of income. Y'all ready? Let go!
And you just wanna get paid, tired of making no money mistakes. Make a payment on your bills and you still late, yeah. Paying for profits to help you seek change, and you just wanna get paid, yeah. Tired of making no money mistakes. Make a payment on your bills and you still late, paying for profits to help you seek change, yeah. Cut the show and just listen. You wanna feel empowered by making money decisions.
So we're gonna go over how we saved her money and how life is a little bit better because of it. Go to the screen. So as we can see, as we go to the screen, she had an income between her and her spouse of $125,000. Right? So with that $125,000, right now, their mortgage is $1,000 a month. Now we did the counts for a 3-bedroom, 2-bath. She is going to be able to rent it out for $1,800 a month. Really about $2,100, but $1,800. So with this $1,800, she's going to get an extra $800 a month. Okay, all right, okay, cool. In red, she has her bills. And bills never go away. And a new mortgage is a bill. And that new mortgage, $2,500. So she was thinking, it's $2,500, and that's at a 7% interest rate. Because we know right now, interest rates, not the best. So $1,000 right now, the mortgage, we're at $1,800, so that's $800 a month, which is $10,000 a year that she is going to get. With the new mortgage, if she gets a new mortgage, $2,500 at $2,000. So right then and there, we already see value, because literally what she gets, what she's paying now, covers her mortgage. So we are breaking even. Because with the money that she receives from the extra amount, basically pays the mortgage. But then, here's the kicker. This is why we were able to save so much money from a tax standpoint, to the tune of $25,000. Let's see if I can make this line a little bit better now. Haha. And we're going to put this in the green, because green is money, 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 money. So this is why things are a lot better in their household, because of planning. You see, when it comes to a tax preparer, his or her job is to just prepare your taxes, hope you get a refund, and keep you compliant. A financial advisor's job is to have you grow your money in the stock market. They typically don't be compensated on real estate, so most financial advisors push you towards that. But see, a certified financial planner, who's a financial advisor and a tax strategist as a CFP, we mirror both. You get the best of both worlds, so you really have a person looking after your best interest. And that's where real estate comes in her situation. So because she now has that house, guess what happens? The new mortgage write-off. Right? Interest that I have on my property, I get to write off the interest. But now, since we're able to structure her property as a S-corp, not an LLC, guess what happens? Her old mortgage is also now a write-off. The interest that she's paying, up to 50% of the interest, is a write-off because Section 162 in the tax code, ordinary, necessary, and fair in pursuit of income for your business. How can I run a rental business when I can't pay the mortgage? I can't. So paying that mortgage is necessary, and the interest, I am able to write off half of that. Well, now it's an older house, her old house. So all those repairs that she's doing right now, she can't write that off. But going forward, those repairs at that old house that she has to do anyways, it's a write-off. Boom. The repairs is a write-off. I know I got scribble. So that is a write-off. Guess what else is a write-off? Utilities. Oh, that's better. That's better. That's better. Utilities is a write-off because we're going to set another LLC as a property management company. So now instead of hiring a property manager, she can do the property management herself, and everything associated with that, she gets back in her pocket from a write-off. But guess what else? She has a grandchild. That grandchild is 12 years old, and he loves him from social media. And she gets some allowance for getting good grades anyways. But now, since she has that rental income set up through her LLC, entity-wise, but taxed as a S-corp, guess what we get to do? Pay the grandchild. And you can pay the grandchild up to $15,000 a year, and they meet the standard deduction. $15,000 paying the grandchild, guess what happens? That's a write-off, right? Now, another thing we're going to do is allow her to do a cost segregation study because she's going to do some repairs to boost up the rent. We're estimating $1,800, but it might be as much as $2,500 by doing repairs in a house that has to be done. So we do that cost segregation study. And cost segregation study allows the IRS to give you a depreciation sooner. You see, right now, the IRS, they give you money on the purchase of your home over a 27-year time period. So let's say we buy a house for $100,000, let's just say. IRS is going to pay you $3,000 a year over those 27 years because they know it's going to be wear and tear to your house. Just like we have wear and tear to our car. Just like we have wear and tear on our furniture. We get to depreciate that. So by depreciating that, we get all that money over 27 and a half years. But what if we're able to do a cost segregation study and then apply that 27 and a half years of depreciation savings all in the first 5 years? We're able to do that as well. So now, because she has that S-corp, we're able to do that cost segregation study, a large write-off. Another thing, because now she's a business, she's working in her home as a business, she's able to do a home office deduction. And with that home office deduction, guess what happens? Now, everything tied to her house, she is able to write off up to 50% of that. She needs cable to work at her house. So now 50% of the cable is a write-off. Utilities, the lights have to be on so that I can run my business in my house. That is now a tax write-off. So everything she's doing now, because she has things structured in the business, she's able to get back. And guess what else? We also said, since you're working, you have a 403B, let's take advantage of that. So we had her increase her allowances. Increase allowance, IA, from 1 allowance to 7. So now she's going to get approximately another $375 per pay period in her pocket. Now, because she increased her allowances and the IRS doesn't take out as much taxes, that means on the surface she's going to pay more taxes, right? She's getting more money. However, we're going to shift that income to her 403B. So now that extra $375 per pay period, or basically $750 a month, is now going into her 403B, not to the IRS. And that $750, which is basically $9,000 a year, guess what that does? That decreases their taxable income. So now the taxable income is not $125,000. Whoop, 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 whoop. Now it's Now it's $115,000. My scribble scrabble is horrible, I know, but you get the picture. So now we have $115,000 of taxable income. That $10,000 of less means in the 28% tax bracket, another $2,800 in their pocket by doing that alone. So by doing all these things, guess what's happening? She got tax savings, an extra $25,000 of tax savings. So she's breaking even with the house. She is getting an extra $25,000 in tax savings. And with that old house that she didn't sell, guess what's happened? It's grown in value. When she bought it years ago, she bought it for $175,000. Now it's at $278,000. In 5 years, if it's worth $400,000, did she make money or lose money? And she didn't pay tax on it either because she needs money with this cash out refi and do it all over again. So this is how we use the tax code to our advantage. And the cost of her waiting would have been a lot more because she would have had another $150,000 of equity into a house. She would have had $25,000 a year for 5 years in tax savings, which is $125,000. And she would not have that income from a rental standpoint either. So don't wait. Don't procrastinate. Execute. If you want to buy that property, don't wait 5 years. Don't wait until you're retired. Do it now and reap the benefits going forward. So that's how we saved our client $25,000. And that epiphany that we had a year ago, we laughed about it today because she's in a way better financial position because we went through that strategy. What do you guys think though? Comment below. Good strategy, bad strategy. Am I missing something or am I right on the mark? Because she did save that money, so I must not be missing something. Anyways, as always, like, subscribe to our channel, share with friends and family as we continue to grow and give this great information for you to absorb and be a better person financially. Anyways, in beautiful Jacksonville, let's make some painful or painless profits together, y'all. Peace.